3, 2.
Okay, good morning to everybody who's following us in this presentation. For us, we have the great pleasure today to present and explain today a very important uh, issue regarding the fiscal treatment related to the capital gains that are eventually generated when a transfer of shares, the ownership of shares are transferred from one shareholder to the other, and not exactly the assets, but what happens with the shares. This is the case we're going to talk about today in this presentation. Uh, my name is Mario Hidalgo, and I'm one of the tax partners with Grant Thornton firm here in Costa Rica. And I have also the great pleasure to share this presentation with Mrs. Ivannia Méndez, which is part of our legal team here in the firm. So we will be more than glad to try to explain these specific matters to all the persons that are trying to follow us today, and we will share, as I mentioned before, this presentation. So I don't know, Ivannia, if you want to introduce yourself.
Thank you. Good morning, everybody. My name is Ivannia Méndez, and I'm part of the corporate legal team of Grant Thornton, Costa Rica. During this morning, we are going to share with you all relevant tax details that must be taken into consideration when we are negotiating transfer of shares in Costa Rica.
Thank you very much, Ivannia. You're more than welcome today. And basically, again, we have a specific agenda that we are going to discuss. First of all, we are going to look at some of the background that we need to know in order to get a clear understanding of the different aspects we are going to mention today. Basically, those aspects are the one related to the tax treatment of the transfer of shares. And due to the new system tax in place here in Costa Rica, we'll have the two different approaches in accordance to the law. The first one is the tax on profits versus the tax on capital income due to the existence of this new schedule regarding the capital gains and losses included in the law by the last tax reform that was implemented here in the country. We'll also review what has been the criteria shown by the tax administration in this particular scenario. And finally, we are going to review certain actions that can be performed by the tax administration to eventually verify the existence of the triggering of a taxable event in the transfer of the ownership of the shares. So without further delay, we are going to review the background, and we are going to talk specifically about the amendment that was performed to the income tax law. And basically, that was the inclusion of a new schedule system regarding rental income and some other sources of income, and basically the fiscal treatment associated to the capital gains. Please bear in mind that before this amendment took place in 2018, capital gains will only be taxable in Costa Rica in the case of an exemption. Now the rule is that all capital gains will trigger the payment of taxes and basically income taxes. This law was or is enforced since July 1st, 2019, and basically what this specific amendment provoked was a general reform of the sales tax, which was transformed into a value-added tax law, and some changes or important changes to our income tax law, which was partially reformed in accordance to the mentioned law. The main change that was performed by this amendment is basically the inclusion of a new scheduler that is called capital income, capital gains, and losses. Now we have four schedulers present in our income tax law. The first one related to the profits, which was the system that we all used and paid taxes by using this system since many years ago, since 1988 to up to date. And we have also the fiscal treatment related to wages and the one that is related to withholding taxes, which are applicable when a non-resident gets a payment, and that payment will be considered as a Costa Rican source income. So basically, capital gains under the new set of rules will pay under, when generated, will pay under the profit system or under the capital income or capital gains and losses schedule, as was mentioned before. So basically, what this reform provoked, as I mentioned before, is the transitioning from the scheduler system to a global system. But this proposed scheme was not duly adopted by the income tax law system here in Costa Rica, because when the law was discussed, or during the sessions in the Congress, some amendments were made there. And so basically what we had at the end of the day of the discussion in the local Congress is a mixed or dual income tax system. We cannot say that we migrated to a global system that is used in other systems, tax systems around the world. And basically what we have in place here in Costa Rica today, it's a dual or mixed income system that will be applicable to capital gains and other sources of income, as I tried to explain before. So basically, based on this dual system, you'll have two different possible fiscal treatments to the business income or the passive income. We will be in the presence of a business income when the income is generated as part of your normal course of business. Basically, when you somehow organize production factors as land, capital, labor, or the rendering of services, and you conduct that type of business in a habitual way. Then if that's the case, all the assets related to the generation of that taxable income will pay income taxes under the business income set of rules. On the other hand, if the assets that generate that type of income are not linked or somehow related to your business income, they will pay taxes under the passive income method. And basically, the passive income method will include the payment of taxes from income that is being generated by interest, dividend, leases, among other sources of income. That's the income that comes from property or rights owned by the taxpayer and other financial corporations that follow certain specific rules and are locally regulated by the local version of the SEC here in Costa Rica. So depending on the relationship between those assets and sources of income with my business here in Costa Rica, I will pay taxes under the first system or under the second method I just tried to explain. So it will depend if there is a relationship between the asset that helps to generate this taxable income to the profit-making activity. If there's no link between the asset and the profit-making activity, that type of income will pay under the passive income set of rules. On the other hand, if there is an affection of the asset and the income that asset helps to generate, that asset will pay under the normal and common income tax set of rules because will be deemed as business income. And again, if there is no relationship between the asset or the source of income that is being generated to the profit-making activity, then those sources of income will pay under the passive income system. So this is how our dual system operates under the current set of rules, and it's very important to have a clear understanding of these two methods, because if we transfer the ownership of shares of a legal entity here in Costa Rica and a capital gain will be generated eventually, if those shares are part of my profit-making activity, I will pay the taxes related to that capital gain under the normal income tax set of rules. On the other hand, if those shares are not related to my profit-making activity, and then I will pay the taxes generated by the eventual capital gain under the passive income method. So we are going now to make additional precisions regarding the tax treatment associated with the transfer of shares. So we are going to review what happens under the normal tax method or system on profits, and also what happens on the tax on the capital income, capital gains, and losses. And depending on that relationship, again, or the link between the capital gain that is being generated by the transfer of the ownership of those shares to the profit-making activity of the owner of those shares. So in order to explain in a more graphic way what I was trying to say before, we have this decision tree in this specific slide, and what happens in the scenario in which you have a sale of shares. If the sale of shares, in my particular case, it's a regular activity, we have to provide an answer to that question. If the answer is no, I'm not habitual in transferring the ownership of shares, that's not my profit-making business, then the eventual capital gain or loss that will be generated will pay under this passive system rules. And we will use different rates that can go from, for the first sale, we can use a rate of 2.25% deducted from the price of the sale of the shares, or 50% on the capital gain. And if the person, the individual that transferred the shares is a non-resident, in accordance to the new set of rules, we will deduct as payers of those shares a 2.5% of the sales price of those shares. That is if we are again under the passive scheme. On the other hand, if my activity is regular, there is habitualness, as part of my core business, I purchase and transfer shares as a main part of my business or profit-making activity, and the answer to the question is yes, that capital gain will be related to the profit-making activity, and therefore the capital gain will pay the corresponding taxes under the income tax taxable system with the income tax law, which for corporations here in Costa Rica, the normal or the common current tax rate is 30%. On the other hand, there's an exemption regarding this type of transactions in which capital gains in the portion of the undistributed profits will not be subject to the tax, because please bear in mind that when we distribute dividends, those dividends will be subject to a different fiscal treatment. So only the amount of money that refers to the value of the shares will be part of the taxable base in this particular scenario. If we are talking or including, in the transaction, the undistributed profits, those will be not subject to the income tax, because again, those dividends are subject to a different fiscal treatment in accordance to the schedular system that our income tax law follows. So this decision tree is very important, and for this explanation, because depending of if the sale of shares is a regular activity, if the answer is yes, the capital gain will be subject to the income tax law in the first chapter of this income tax law, and the capital gain will pay taxes under a 30% tax rate. On the other hand, if I'm not habitual in the sale of shares, then that capital gain will be treated from a fiscal standpoint using the passive system or method I explained before. So it's very important to have this in mind in order to understand what happens next. So we have then two different tax treatments in the transfer of shares. The one is tax on profits, which is the case if I am habitual in the sale of shares, then this set of rules is the one applicable. So we are going to make some additional decisions regarding this matter. So again, as I was trying to explain before, if the transfer of shares in accordance to the law is related to my profit-making activity, then that will trigger a taxable event that will be taxable under Article 1st of the Income Tax Law. On the other hand, if that is not the case, and I'm not habitual, and there's no relationship between the transfer of the shares here in Costa Rica with my profit-making activity, then the passive system is the one that will be applicable in this specific transaction. So again, it is important to stress or mention that in certain sections of the income tax law, and that's we are going to include in these specific slides, and it's the different provisions included in the income tax law that regulate this matter, as I was trying to explain it before. So basically what the law says is that if the sale of shares is related or linked to the profit-making activity, it will be considered as part of your gross income, and therefore you will have to pay taxes using the set of rules related to the income tax law. On the other hand, if that capital gain generated by the transfer of those shares is not related, linked to my profit-making activity, there's no habituality involved in that transaction, then that capital gain will not form part of my gross income and will be considered, as the law states, one of the gross income inclusions. So this is very important to understand and keep in mind. And basically, that is the conclusion that I was trying of what I tried to explain before. So if we have certain elements present regarding the transfer of shares in income tax, you need 3 elements to be present. Number 1 is the habituality. You have to be habitual in the transfer of shares. It has to be related to my profit-making activity, and those shares have to be related or there has to be an affectation to my profit-making activity. If we have these three elements present, then the fiscal treatment that we will use for the capital gain that or the loss that was eventually generated by the transfer of the shares will be the income tax law. And that's the main conclusion that we want to share this morning to you. On the other hand, if the capital gain generated by the transfer of the shares in this particular case is not habitual, is not related to my profit-making activity, and is not related again to my core business, then the capital gain will pay the taxes that were eventually generated, basically observing and applying the set of rules under the passive method I mentioned before. So those capital gains in this particular case will be taxed, or the fiscal treatment associated to this capital gain is the one described on the section of the income tax law related to tax on capital income, capital gain, and losses. And that's the section we are going to explain in this next slide. And basically, in the slide, we mention the articles of the law that basically regulate this type of transactions, which are Articles 21 and 27, 27 and 27Bs of the income tax law. Those articles are included on the passive income section of the income tax law. So taxation of capital income, capital gains, and losses are the type of sources of income that are regulated under this set of rules. And unless expressly provided otherwise, the regulations will be applicable to tax on profits as to what is affected by such tax. And that's how the law again reminds us that if the sale of shares is related to my profit-making activity, is part of my main course of business, then we will not use this set of rules. And on the other hand, we will use the first chapter of the income tax law related to the normal or corporate income tax, and also to the individuals that generate taxable income that will be subject to the same type of rules. So it is very important to have or conduct a verification of whether or not the activity is for the current taxpayer a profit-making one or not. Therefore, this fiscal treatment will be triggered when a taxpayer generates Costa Rican source income derived from capital and realized capital gains and losses, because the capital gains have to be realized in order to be taxable. If that realization principle does not take place, then the tax will not be applicable. And those capital gains need to come from assets or rights owned by the current taxpayer. And that will be the basic set of rules that we will have to follow in this particular scenario, which will be the taxpayers, well, all individuals, all legal entities, collective entities without legal personality, and investment funds contemplated under certain specific laws of the Costa Rican legal framework, which are mentioned in this slide, as well as any other similar legal figure that captures resources from the securities market and obtain income from those taxed by means of this chapter during the corresponding fiscal year, which is or runs following the calendar year under current set of rules, will be considered or deemed as taxpayers for this type of passive income method. unless, and that's again when the law reminds us that if those income has been generated or related to a tax profit making activity, then we will migrate from this system to the habitual income tax return set of rules. So constantly the law makes this type of um, calls and suggests to the taxpayer which is the correct fiscal treatment depending on the circumstances that are present in every transaction. So in accordance to this passive method I was trying to explain before, we have income from capital, and the law divides this capital or this type of income that comes from capital, I'm sorry, on three different types of income. The one that is derived from real estate, which is leases, subleases, constitution or assignment of rights of use or enjoyment of real estate. In the case of movable capital, will include their interest, leases, rights of use or enjoyment of personal property, intangibles, royalty, dividends, among other sources of movable capital income. And basically, regarding the capital gains or losses that will be considered as part of such set of rules, any change or modification or in the value of the taxpayer's heritage, including sales of investment funds shares, if that's the case. So basically, what the law states under this set of rules regarding the taxable base, if we are going to be in the presence of a onerous transfer, then the capital gain or the loss will be determined by subtracting from the sales price the acquisition value of those shares in accordance to the information that has been properly or duly recorded in our accounting books. On the other hand, if there is no money involved, for example, we are in the presence of a donation, then we will use or register the new acquired asset using the market value of the specific goods or rights that are going to be incorporated to the heritage of the taxpayer. So basically, the capital gain or the loss, depending on what happens, will be determined subtracting from the sales price the acquisition value of the shares. And those are the current set of rules. Regarding the tax on capital income and capital gains and losses, sales price or transfer value, we have certain specific rules that we need to follow in order to determine in a correct fashion the capital gain or the taxable base for the capital gain tax. So the transfer value will be constituted as follows. We have the amount actually paid for the sale from which the expenses and taxes inherent to the transaction can be deducted when they were in charge of the transfer. So, for example, if we are talking about any property transfer tax and that property transfer tax was borne by the person that is going to be the seller or the transfer in the transaction, he will be able to deduct those specific expenses and from the sales price. The transmission value should be in accordance with what the parties had been agreed as if it were independent parties under the normal market conditions in accordance to the law. And again, if the transfer occurs between related parties, we will also need to include or use the transfer pricing set of rules that are currently described in our income tax law. Regarding tangible assets, I just want to review the existing rule. The acquisition value will consist of the sum of the following. This is only applicable for tangible assets, not for shares. So the main original rule that is included in the law says that the acquisition value is the actual amount of which the acquisition was made, and that will include the cost of investments and improvements made to the assets that were acquired, not included interest or third-party financing. Also, we can include expenses and taxes, as I mentioned before, inherent in the acquisition that have been paid by the acquired, not including interest on third-party financing. So if we are talking also about tangible assets, which can be subject to depreciation, they might be considered depreciable goods. Then to the result of this sum, the amount corresponding to the accumulated depreciation at the time of the transfer must be also subtracted. And again, that will take place regarding tangible goods, because intangible assets are not subject to depreciation. Therefore, the acquisition value will be updated based also on the changes in the consumer price indexes determined by the local utility in charge in Costa Rica of handling those matters. So there's a possibility to somehow update the value of the tangible assets using these changes in the consumer price indexes determined by the local authorities here in Costa Rica. And again, this specific set of rules are the ones established by the law regarding tangible assets. In the case of intangible assets, we have to observe certain also specific rules, and the law distinguishes between two possible scenarios. The first one is when you have an onerous transfer of the shares admitted to a trading on an organized market recognized by the Costa Rica authorities. If that's the case, the gain or the loss will be determined by the difference between, again, transfer value, which is the market price on the date of the transaction, or the agreed price if higher, and the acquisition value, deducting the amount corresponding to the transfer of the subscriptions rights. So you subtract from the transfer value the acquisition value, and then we will have the taxable capital gain or loss, which is going to be subject to the corresponding rate that we mentioned on a previous slide. Therefore, on the other hand, and the second scenario is a transaction, an onerous transaction of shares that takes place on a not admitted to trading on an organized market recognized by the Costa Rican authorities. So the gain or loss shall be the amount satisfied that it is shown would have been agreed upon by independent parties under normal market conditions. In the absence of the foregoing, it shall be determined by the difference between the transferred and acquisition value in accordance with the following set of rules. This is again for the second scenario. These are the specific rules for the evaluation of a taxable base in the case, again, of an onerous transfer of shares. And basically, the acquisition value in this particular scenario, in this case, or in the case of securities or participations received through the reinvestment or capitalization of profits, then if they are partially released shares, that refers to those shares or participations in which despite of the originating in the reinvestment of profits, part of their value had to be dispersed. And we have the fully released shares, which are the type of shares received as a result of the reinvestment or capitalization of the profits without having paid any amount. So the acquisition value will be the amount of money satisfied by each one of them, and the acquisition value, both of the shares originally owned and the new ones originated in the capitalization or the reinvestment, is the result of dividing the total cost by the number of titles. And again, these are specific rules that will be applicable under this particular scenario. The common rule was the one I just tried to explain before. And again, we are going to review the rates that will take place on the capital gains and losses, the ones that will be applicable if the transfer of the ownership of the shares is not related or directly linked to the profit-making activity, and eventually will be treated under the passive income set of rules. And those, the ones that appear in this slide, are the ones that will be applicable to such transaction. The normal rate is 15%. That's the general rate on the capital gain. On the other hand, if the shares were acquired before July 1st, 2019, the law provides you the opportunity to select between the general rate, which is 15%, or a 2.25% of the sale price. If you don't have a clear understanding of the acquisition value of those shares, then if this is the first sale and we are talking about shares that were acquired prior to July 1st, 2019, the law permits that you will be able to select between the general rate again and a 2.25% on the sale price. That will take place, that possible selection will only be applicable for the first sale, regarding again shares that were acquired prior to July 1st, 2019. If you are talking about a second sale or the following sale of those shares, you will only apply 15%, which is the general rate on the capital gain that has been determined. And in addition to these two specific rates, we have a third additional one, which is 2.5%. And that rate will be applicable under the scenario in which the transfer of the shares is a non-resident. And that rate will be applicable to shares and also to tangible assets that again are acquired from a non-resident seller. The big question here, and one of the things that, or the aspects that were left out in the law, is what happens when both the seller and the purchaser are both non-resident person or individual for tax purposes. So we have here a real important problem, because if both parties are not domiciled in Costa Rica for tax purposes, how is the tax administration going to control this transaction? So we can find here a very important loophole in the law. And again, this specific rate of 2.5% will only be applied when the transfer is a non-resident and the person that is going to acquire those shares is a resident individual or a resident legal entity here in Costa Rica for tax purposes. Unfortunately, the scenario that will take place between two non-resident or domicile parties in Costa Rica for fiscal purposes was not included in the law. And we were not able to find yet any provision regarding this particular scenario on the bylaws of the income tax law. Okay, those are the rates. And just to keep in mind, on the other hand, if the capital gain is somehow related or linked directly to my profit-making activity, then these rates will not be applicable. The rates that will be applicable are the ones that we use under the first section of the income tax law, which is tax on profits, which for normal corporations is 30%. For the case of individuals, and we are talking about resident individuals, they have a progressive scale that needs to be applied on the net income. But again, that will be the scenario or the taxable treatment that will be applicable for a capital gain generated in the transfer of shares that are linked or directly related to my profit-making activity. So from a formal standpoint, the form that normally is going to be used or currently is going to be used is the D162 form. 162 is the format that we are going to use to pay this tax under capital gains and losses system. If we are talking about a capital gain that was generated in relationship to a profit-making activity, we will use the customary D101 form. The D160 form is the one that we are going to use if we are going to pay the capital gains tax from a passive income standpoint. So here's an illustration in this slide or a description. I'm sorry, it's in Spanish because we don't have an English version. This form has been captured from the current platform that is used by the tax administration. And then, as you can see, you have to select certain circumstances related to the transaction. And we have here the different rates. In this particular case, we are using 15% on the capital gain. We are saying that it's a movable asset. And we are in the description including acciones, which in Spanish means shares. It is very important to say again, which is the country, or if the purchaser or the acquirer is a Costa Rican resident for tax purposes, and the form will automatically estimate the tax. So there is no many things to check on this because again the form will automatically estimate the tax in accordance to the different values that I include or populate within the form in this specific platform that is managed by the tax administration. And in this following slide, I would like to draw your attention to the different type of rates for the first sale, the 2.25% and the 15%. Why does the 2.5% does not appears in this form, in the D160 form? Because the 2.5% is related to withholding taxes, and the payer, the person that is the individual that is going to acquire those shares from the transfer from the seller is the one that needs to deduct the 2.5% of the price that that person paid to the transfer. That's why that rate of 2.5% does not appear in the D-160 form, because under those circumstances we will have a different set of rules. The D-162 form is the one applicable for the passive income method, and basically we have the 2.25% rate for the first transactions for those shares that were acquired before or prior July 1st, 2019, or 15% on the amount of the capital gain that was determined using the rules that we explained before. And basically, this D-162 form is going to calculate or estimate automatically the tax that you are going to pay, and then you can use any of your bank accounts in order to transfer the said amount to the tax administration, and in that way you will comply with the filing and declaration procedure regarding these particular cases. So from this moment on, I will share or I will ask Ivannia to take care of the presentation from this moment on, and she's going to refer to the criteria of the tax administration that has been issued by them regarding this type of transaction. So welcome again, Ivannia, and please go ahead with the presentation.
Thank you, Mario. Having then gone through the background and the tax treatment, we need to overview the criteria of our tax administration on this specific subject. Before law for the strengthening of public finances and in accordance with Officio DGT 1093-2015, any sale of shares generated by elements unrelated to the production factors and the taxpayer's habitual profit-making activity was not taxable with income tax. The mentioned criterion was based on Article 6 of the Income Tax Law, which before the reform establishes an exclusion from the gross income. Specifically, capital gains obtained by virtue of transfers of movable and immovable assets in any capacity, provided that the income from such transfers does not constitute a regular activity, in which case it shall be taxed in accordance with the general rules of the law. In this regard, it is valuable to identify an extract of the specific criterion, which mentions, it is concluded that the profits obtained from the purchase and sale of shares constitute a form of capital gains that in principle do not form part of the product income because they are generated by elements aligned to the production factors and the usual profit-making activity of the taxpayer. On the contrary, any eventual profit produced by the difference between the purchase and sale price of a share comes, strictly speaking, from elements related to market situations and the financial profitability of the company, which is why it would be included in the income. Notwithstanding the aforementioned, once the new law came into force, the administration criterion has been to consider that the sale of shares cannot be typified as a business reorganization, as indicated in Article 27(4) of the Income Tax Law. The tax administration considers that this is not a business reorganization mainly because the valid economic reason and the continuity of the business are usually not accredited. Okay, we have here the criteria of the DGT, and it's because the sale of shares is not a case of business reorganization, though capital gains are subject to tax on capital income and capital gains are in losses. To conclude, very quickly, I will mention those actions that can be performed by the authorities to verify the existence of the triggering event of the correspondent tax. We got to remember that the law to improve the fight against fiscal fraud established the obligation to maintain a registry of transparency and final beneficiaries. Registry that is managed by the Central Bank of Costa Rica and annually fed with information that various corporate structures are obliged to provide. So, during April of each year, all corporate structures must submit their ordinary statements. However, an extraordinary statement must also be filed when any of the owners of the shares equals or exceeds 15% of the total of the respective type, or there are variations in the final beneficiaries by other means of control. Said extraordinary statement must be filed within the following 15 business days, counted from the entry in the official stock registry book of the new shareholder information. Bearing this in mind, our authorities have considered as a legitimate reason for the use of the information contained in such registry the need to comply with the functions of the tax administration, even more if in those cases in which a control action has been initiated and notified in order to determine a potential tax debt ex officio and for the collection related to such ex officio determination, and also in order to carry out tax inspections through the officials of the tax administration inspection areas. Before ending our webinar on allowing questions, as a general summary, we can point out. First, since July 1st, 2019, transfer of shares are taxed. In accordance with the income tax set of rules, if the correspondent transaction is considered as part of the profit-making activities, and in the contrary, if the specific transaction is not habitual and changes the value of the taxpayer's heritage, it will be taxed under the passive income method. Second, the applicable rate will vary depending on the specific situation, but the range per transaction, we have to remember, goes in accordance with the tax on capital income, capital gains, and losses from a 2.25%, considering a first sale scenario, to a 15% maximum, which constitutes the general rate, and in accordance with the provisions of the tax on profit, a 30% rate. And last but not least, as of to date, any transfer of shares will be eventually known by the local authorities, since all corporate structures has the annual obligation to submit the Central Bank of Costa Rica the updated information on its shareholders and final beneficiaries, with fines and penalties being applied in the event of non-compliance. We really hope that this has served to let you know a little bit more of the current legislation and clarify some of the most frequent concerns. I think, Mario, that we have a couple of questions to be answered. The first one, I joined late, but would like to know about the new law which establishes an income tax to inactive corporations based on the value of the assets. Is that true?
Yes. Well, thank you very much for your question and participating in this webinar. Well, basically, what happened is that in the same law that Ivannia was mentioning, there was an amendment in Article 2 of the income tax law that stated specifically that inactive corporations will be considered as taxpayers in the income tax law for formal purposes. An inactive company is the one that is defined as the entity that does not receive any income from a Costa Rican source income. They can receive, those type of entities can receive income from abroad, from a source that will not be taxable in Costa Rica, and that will not make that the company will be an active or deemed as an active one. Inactive companies, again, are the ones that will not receive any Costa Rican source income. And basically, the amendment of the law, what triggers is a formal obligation that those type of companies that only are holding companies of assets, either tangible or intangible assets, will have eventually to file an informative tax return on March 15th of the year 2021, and that obligation will take place on a yearly basis. Basically, there was going to be used a D-135 format to complete that formal requirement. Nevertheless, last week, a new private ruling issued by the tax administration stated that the D-135 form will not be used, and we will use the D-101 form normally used for the filing of income tax, but you only will need to complete the first section of this informative tax declaration. Basically, what we will need to include is your liabilities, your assets, and basically everything related to the equity of the company. Why is the tax administration doing this? Well, eventually they want to conduct inspections on every company to find out where the resources that were used to purchase those assets came from. And what they are trying to look up for is any unjustified increase in the equity of the taxpayer. So what is the solution? Because in Costa Rica, it's almost a hobby to have different assets under the name of a company for different reasons, protection of the equity, for example, or for the transfer of the ownership of those assets using the sale of the shares, for example, and you might have a variety of reasons. Nevertheless, it is also important to stress that it is also customary that in many cases those holding companies do not have a current accounting set of books. They don't have the legal information at hand. So our recommendation, in order to comply with this new formal requirement that will take place again, as I mentioned before, on April the 15th of year 2021, is to try to reconstruct the accounting records of the company and also generate the proper legal documentation in order to have a mirror between those legal documentation and the accounting records. And that in that way we'll be able to provide a proof of the origin of the resources that were used for purchasing those assets. Again, this not trigger paranoia or an alarm on this regard. We have to take care of these situations only and try to reconstruct. If in any case it's impossible to get the background documentation or any, for example, the public deed which was used for the acquisition of the asset, for example, then our recommendation will be to extract those assets from this company or merge this company to an operating one and an active entity in order to avoid any undesired attention from the tax administration to this type of companies. But again, it's at the beginning, it's only a formal requirement in which those inactive companies, so please check on the platform that is currently managed by the Hacienda or the local tax administration here in Costa Rica, and see how your companies are currently classified, under which code they have been classified, and see if they are have been selected as inactive companies or not. If you have any inactive company, will be required to comply with this formal presentation of the D-101 form regarding the assets, the equity, the liabilities of the company. And that's basically what we have to say about that. And again, the solution eventually to be able to handle any inspection that might be conducted by the tax administration will be to have the corresponding accounting records and the legal documents that would also support those accounting records. For example, a minute stating that a capital contribution was made by the shareholders of the company, and so on, and that will be able to be documentation enough in order to avoid any unnecessary discussion with the tax administration. But again, this is a new formal requirement, and any inactive company will have to comply with it in March 15 of the year 2021 on.
In addition, Mario, we got to remember that every single corporation, active or inactive, has an annual obligation of holding a shareholders meeting in accordance with the commercial code. So it's very important to take this into consideration too.
That's right.
Okay, another question here is, what if an entity A transferred to an entity B the shares of a Costa Rican entity, but the entity B pays a higher price than the book value? Is there any capital gain tax payable? Please take into consideration that both entities, A and B, are not Costa Rican, but also both of them have the same shareholders, and the sale of the shares is not a regular activity.
Okay, that's a very good question, and by that question, we are referring to two different scenarios. The one is the one that I want to take aside first is the one that Ivannia explained previously. And if the shareholders are the ones, or we have the same shareholders between entity A and B, or regarding entity A or B, we have the same shareholders, and basically what we are going to do is to somehow reorganize the assets or the structure of the corporation or the structure of the corporation. That will not trigger a taxable event, and the value that we need to use is the book value of the entities. If you are going to use a different value than the book value recorded in the accounting books of the company, a capital gain will be triggered. And if we use that amount, then we'll again draw unnecessary attention on the transaction from the tax authorities. So my recommendation will be to use, if we are going not to change, we are not going to include new shareholders, we are not to exclude any shareholders, and business will continue as it was taking place before, then we should use in this transaction the value included in the accounting books. If we use a higher or a different value, then we will trigger taxable capital gain, and that means that we will have to pay taxes. As we mentioned before, in this particular scenario, we are talking about two different shareholders which are not resident in Costa Rica. And unfortunately, the law did not include this scenario. The only scenario that was included was when the purchaser is a resident and the seller is a non-resident. And then that's why we apply the withholding tax rules. But in this particular scenario, in the one in the question, we are talking about two different shareholders, and those shareholders, none of them is resident in Costa Rica for tax purposes, and therefore we have a practicability issue, and we were not able, because in order to apply what the law says, the purchaser of the shares will have to come to Costa Rica, register itself, the company, as a taxpayer, pay the tax, and then if the shareholders want, they will exclude that company from the register. But it's the only way in order to comply with that payment. But again, the law did not address properly this matter under the current set of rules.
Okay. Another question is, which form number do we have to use to report the tax of 2.5% of a sale to a foreign party?
That's a very good question. That will be the one that is used for retentions or for withholdings is the D-103 form. But we are talking about a Costa Rican resident for fiscal purposes.
Okay. If a foreign person sells a property, lives in Costa Rica but does not have a residency, does he or she have to pay 2.5% of the sale price, or a different rate should be applied?
Okay, exactly the same for tangible assets. If you are going to transfer the ownership of the asset itself, the property, and you're going to sell that property, again, the purchaser of that property is the one that needs to deduct the 2.5% from the sales price and pay that money to the tax administration.
Okay. If I have a foreign company with only a cédula jurídica number type, I should create a Costa Rican chapter of my accounting to comply with the obligations of tax declaration now.
Yes, if you have an asset and you have a power of attorney duly registered here in Costa Rica before the National Registry, you have a permanent establishment and you have to comply with all formal requirements. And one of them will be to have a set of accounting books following the local standards for Costa Rican accounting purposes.
Okay, another one about inactive corporations. If we do not have the acquisition price, can we use the costo or cost at the National Registry to make the new report?
Yes, that's a very good question. If somehow we don't have access to the original public deed or the contract document that was drafted for the transaction, we might be able to use other sources of information. The value of the asset in the local municipality or other sources of information, but those sources eventually could be challenged by the tax administration. So we have to be very careful with that, generate all the proper documentation in order to be able to show proof of the value of that property. But again, if we are not in a position in which we can have access to that public deed or regional public deed, then our recommendation will be eventually to try to use another source of information that can be confirmed by the tax administration if an inspection or a tax audit is conducted.
Okay, and at last, what is considered a regular activity?
Okay, that's also a very good question. Basically, what the law says is that you have to distinguish between your normal profit-making activity, and that's the main course of business of your activity. And that is what's called the habitual or regular activity, and that's the one that we should pay taxes under the income tax law. On the other hand, if we have other sources of income generated by assets which are not related to that profit-making activity, then we will have to use the set of rules related to the passive income method. And again, we can have, any taxpayer can have different activities and different assets operating at the same time. That means that eventually that particular, under that particular scenario, that taxpayer might be able or will be required to file and pay taxes under the two systems at the same time. And I'm going to try to set an example saying that, for example, if I'm a professional that renders services, I don't know, medical services or legal services, and I have under my name an apartment that I normally lease to third parties, that source of income that comes from the apartment is not related to the professional service I render. That's why I will be required to file the D-101 form for my professional legal services and a D-125 form for the rental of the lease, because again, that type of source of income under the example we are constructing is not related to my main profit making activity. So again, it's possible that any given taxpayer that has different activities, that have different assets, and those assets are not all related or linked to the profit-making activity, will have to comply with the two types of income tax that we try to explain throughout this presentation.
Okay, Mario, I think that we have covered all the questions. Now we just want to thank you, our audience, for their participation, and please feel free to contact us at our office number, phone number, or even our emails if you have further questions.
Yes, thank you very much, Ivannia, for your participation, and again, by this event, we try to share with you the main aspects regarding the probable tax treatment related to the transfer of ownership of shares. As you can see, we have different scenarios, we have different set of rules. So it will be, if there is any important takeaway for today, is check on your companies, check how they are being recorded currently and the tax administration, and what type of activity has been declared before the tax administration. If only you have services, or you have also rental income, or you have other type of income, in order to be able to sort out which are the best rules that you need to apply or observe in order to comply with the tax obligations here in Costa Rica in a duly form. Thank you very much for the time that you have dedicated to this presentation. And as Ivannia mentioned before, we'll be more than glad to try to help you if you want to send us any consultations regarding these aspects we described today, or any other issues regarding tax matters. Again, we will be more than delighted to try to help you out. So thank you very much, and we will be in touch.